let's revise alternate investments, learning module 1. So in learning module 1, we firstly have in an alternate investment features, then we have its method, then we have its structure. So firstly, when we talk about features and categories, we have three types of alternate investments, that is private capital, real assets, and hedge funds. Okay, so let's just go with the notes first, then we will take up the core and see we are not missing out on anything. So firstly, we can see that individuals, they save and invest in three types of instruments, or like the ways, that is equity, debt, and other assets. So equity, we do know that it could be public or private. Then debt also, we know that could be public or private. So public equity and public debt combines and makes up our traditional investment, the one that is on stock exchange, like the shares we buy. Okay, and the private equity and the private debt. Private equity comes from the equity, like venture capitals, when they are investing in private companies. So private equity and private debt combines to make up private capital. And then there are other assets, in that also individuals can invest, and we, our current focus is on these assets. So these assets could be investment in natural resources, real estate infra, and digital assets. So real estate and infrastructure and natural resources combine to make real assets, and private capital, real estate, natural resources, digital asset, all the other assets plus private equity and private debt makes up our alternate investments. So when we have a public equity and public debt, it makes traditional investment, and all the other things are alternate investments. And now we are talking about the features of alternate investments. Their features is lack of liquidity. For lack of liquidity, we can just think about real estate, like they are illiquid and it takes time to sell sell them to get like liquidity. And then we have inefficient market. So for like public debt and public equity, the market is very inefficient. There is a sale purchase going on every second, so that makes its market very efficient. But for alternate investment, the market is very uh, inefficient, as in the way it, as it like there is problematic and lack of data. They are the source of generating, but they are the source of generating alpha, because in efficient market you cannot generate alpha. In efficient markets you cannot generate alpha because there is a minute, there is no scope for it. But in inefficient market there is a scope for it. That is why you expect higher returns from them also, because they are illiquid also and they require specialization. So you need someone who so you need someone who knows how to invest in them and how to get good returns out of. So that and for that specialization, fund managers are hired, and that means then they charge in higher fees, and fees becomes a huge part of alternate investment. And then legal and taxation complexity, like we can just think about cryptocurrency, like how their taxation and legality, like how vague it is right now. So legal and taxation complexity. So now the features of alternate investments are: they are illiquid, they have inefficient market, and legal and taxation complexity. Now the second part of the chapter comes up, that is traditional investment, that is direct and indirect. And then we have limited partnership. So so earlier we might have learned about limited liability partnership, but limited liability partnership is different from limited partnership. Limited partnership is the model that is basically used by private equity funds and hedge funds. So basically in the limited partnership model, there is a general partner who manages the fund, and all the limited partners invest their monies with the general partner, and he is the specialized person who puts the money in the different sources and get them returns, who like invest and then get them returns. And these are accredited investor limited partners. Accredited investors means they are specialized in investment, they know what they are doing with their money. And general partner has unlimited liability, and the limited partner's liability is limited to the committed capital or whatever they have invested. Okay, then we have hedge funds. So hedge funds are, you can think about mutual funds, but hedge funds are different from mutual funds because they can do long and short. So mutual funds, since mutual fund don't have accredited investment, everyone can invest in it, and it has regular investors, small investors, and just to safeguard them, they cannot do short selling, because if you let a fund do short selling, they are just too much focused on getting the profit, and they can sunk the whole investment of a small investment for a small investor. So that is why for mutual funds short selling is not there, but hedge funds can do everything, everything under the sun. So hedge funds can do long and short, they do high leverage, debt, borrow, and derivatives. They have very complex strategy, will not disclose everything, less regulations, they cannot advertise, concentrate, and less diverse होती है. Now it comes to additional features of alternate investment. So alternate investment does leveraging, short selling, and they have low correlation with traditional investments. Okay, then we have alternate investment types. It could be private capital, so private equity, private debt, hedge fund, real estate infra, natural resources. And we talked about real estate infra, natural resources combined to make real estate, and we have digital assets. Okay, now we have our hedge fund. So for hedge fund, fees calculation is a very important part of this learning module. So for fees calculation, the fund manager get two types of fees: base fees and the incentive fee. So base fees is the fees that the hedge fund manager will get anyhow. It is not dependent on anything. And the base fees, you have, when you are doing the sums, you have to see like it's calculated on the beginning value, ending value, or the average. So in most of the sums we have seen it's calculated on the ending value. And the base fee, if it's the case of a hedge fund, is calculated on the assets under management. But if it's a case of a private equity, it's calculated on the committed capital, not the capital they have invested in the fund currently, but on the whole committed capital of the investors. Then we have okay, then we have incentive fees. So incentive fees is the fees that they get if they get us the higher returns. So as the name suggests, generally there is a so incentive fees basically comes like, uh, if it's a fund of 100 and it earns 20% at the end of the year, so our ending value is 120, and our management fees, if it has to be calculated on the ending value, then our base fee will be like 2% of 120, so that becomes a 2.4. And our performance fees basically will have a hurdle, like if you earn more than 10%, then you will get a incentive. So since they earn 20% on the 10%, we will calculate the incentive fees. And in hard hurdle, so if they earn 20% and our hurdle is of 10%, so they will earn on the rest of the 10%. But if it's a soft hurdle, we just need to see the hurdle as a way that if the if the performance is more than the hurdle, then we will calculate it on the whole percent. If it's a soft hurdle, then incentive fees will be calculated on the 20% rather than the 10%. Okay, then we have a few questions. Then we have a watermark. So high watermark case does not comes up in the first year, it comes up in the third year. So basically, uh, at the end of year one, and year one after in year two, the manager earns us a 20%. And then we have given them a base management fees and incentive fees on the 20%. And after the end of third year, they earned us only 10%. They have given us a loss of 10%. So they have given us a loss of 10%. And since they have given us a loss, we don't want them to give them the incentive fees on the same amount twice. And if in the fourth year they only give us 12%, so that means they have covered up the loss of 10% and they have given us 2% more. But if we look at it, in the first year they have already given us 20% and we have already paid them on that 20%. So this 2% is the amount they have just recovered back from what they have already provided us. So we won't be giving them any incentive fees. So high watermark is basically to see that if management has given us a high point of a return, and on that return we have already given them the incentive fees, we won't be giving them the same incentive fee on the amount if after they have sanked us down. So then we have fund of fund. So fund of fund is an investment company which invests in other hedge funds. So hedge funds are very much specialized. If one hedge fund is specialized in the real estate, then they will be investing all much in real estate only. So fund of fund is basically a fund that invests in specialized hedge funds. So different hedge funds could be basically like event driven, relative value, macro hedge fund, and equity oriented. Advantages of investing in fund of fund is diversification across different hedge fund styles. Due diligence of individual hedge funds will be carried out by the FOF manager. So already a particular hedge fund manager has carried out due diligence. So fund of fund manager don't have to carry out that much of due diligence and can just invest in a lot more verified portfolio. But it's there is one negative to it, that it will have double edged fund, because already that hedge fund managers will be taking a fees. Now the fund of fund hedge fund manager will also be taking fees, so that is like a double layered fees. And hedge fund managers, since a fund of fund is like a huge fund, so and in hedge funds small investors cannot invest, so they get like really good um, conditions on negotiation. And yeah, now we have one more LOS, that is on alternate investment versus traditional investments. I think we have covered this. So for traditional investments, income mutual fund, transparency होती है, low management fees, greater liquidity, reliable historical return data, and limited use of leverage. And alternate investments may there is not that much transparency, management fees higher, and a complex way of calculating it. They are illiquid and not illiquid, lower liquidity. And there is not historical return data is not readily available, and but they use leverage a lot and derivatives and short selling. Then we have private capital. So private capital is really important because private capital includes private equity and private debt. So private equity is of two types: venture capital and buyout. And so basically when you think about question, even though venture capital and buyout both comes of private equity, venture capital in question wise is like considered as a separate thing. So in venture capital, uh, investment is done in the startup or early age companies to help them grow. It's like high risk and it could be a high reward situation. But buyout is basically when you are buying out a well established company when it's in a maturity or a decline stage, to like reorganize, restructure, to like give it a reboost and like get good returns. So now we will just discuss private equity fund, like basically like hedge fund in this structured form. The only thing is um, it has a general partner that charges management fees of committed capital that we discussed. And even though committed capital is $500 million and it takes management fees altogether $5 million, but it invests very slowly. And we see a sum where it talked about how having the management fees on committed capital at once is what motivates the general manager to be very careful with the private equity investors money, and to carefully invest it, and carefully and slowly invest it, rather than just uh, barging out with this money and quickly investing it, so that to get like a good return, so that to get a good investment phase. But since they already have a good management fee, they don't have to resort to such ways. And here incentive fees could is also carried out as carried interest, and it could also be called as preferred return. Yes. But now there is one extra thing in private equity, that is a clawback provision. So it is a requirement that journal partner return back any carried interest like performance fee received earlier, so that so if a case happens that in the next year journal partner is not able has like reduced the ending value to less than like whatever they have earned, and they have earned the incentive fees on, so they have to return back what they have earned on the fees part only. So now there are four different types of investment made by PE fund: distress investment, deployment, developmental and capital investing, budget buyout fund. So distress investment invest in the debt of a firm in financial distress and actively manage the same. Development capital, PE fund invest in public or private entity requiring capital for development and reorganization. Such private investment in public companies known as PIPE, private investment in public equity. Okay, then we have buyout fund. It uses leverage debt to invest in a public limited company, which it intends to make private. So buyout may up you invest in a public company through debt, and then to later return in a private company. Okay, and then we have the concept of MBO and MBI, management buyout, management buy it. And management buyout is the existing management together with the PE fund. When they buy the company, then it's management buyout. But if an outsider comes and replaces the management, then it's a management buy-in, that they have buy-in the management. Since immense amount of financial leverage is used, the typical target for buyout fund is a company with stable cash flows, because they are using debt now, so they need to pay their interest and the debt back. So mostly they invest in companies with stable cash flows. So the plan is to generate sufficient cash flows to repay debt in 5 to 7 years, and their exit strategies are that they can do strategic sales to another strategic buyer, or a non-strategic sales to be a fund, or a public issue. I reverse. Okay, so they took a public company, they invested in through debt, they made it a private company, and then to exit out of it, they issued an IPO, so made it again a public company and reverse LBO. Then it's leverage recapitalization of the portfolio of company under construction will take up debt to pay heavy dividend to PE fund. Then we'll, if nothing happens, then we'll just liquidate the company. Now we have venture capital investment. This is an investment by PE fund in young unproven entities wanting to test some new technology or idea. High risk, high scope of return. It could be done in various stages. So angel investing is basically when you ask your known people, like your relatives or someone, to invest in your company, and they are doing it on your potential, on your idea. Seed capital investing is by PE fund for product development and early stage for starting a commercial production and sales. Then this is format of stage. It could be through angel, seed, or early stage like PE fund. Then we have late investment when you are like having like a little bit of growth, but you want to expand production to increase your sales. And then we have mezzanine stage investment to help the firm plan an IPO. Then we have some general points, active investment. Then we have a point that mezzanine is used twice. So management stage financing is the stage just prior to IPO where VC1 invest, and mezzanine stage financing is the X stage where the venture capital invests just prior to IPO, and mezzanine investment is a hybrid debt instrument with warrant or debt with the conversion option, that you give them debt with a conversion option that the debt can be changed to equity. Now we have real estate, real then real estate, natural resources and others come under real assets. So real estate is our main bucket, real estate and infra, natural resources others. So real estate, when we talk about, is of developed land. It could be commercial and residential. It's important that we are able to bifurcate commercial and residential. So commercial, their primary source of cash flow comes from private economic activity, while in commercial, rent and mortgage payments is that. And then there is also multifamily homes. There could be commercial, residential, depends on their scale. Then is how do we invest in real estate? We can do it through equity, through debt. Equity is private investment in property, or private real estate fund, or private real estate partnership, where like some people comes up and form a partnership and invest in real estate. And debt is private. uh, you give a loan to someone else to buy a real estate, that is private debt to invest in real estate. And or if private real estate debt fund is there. And how do you invest publicly? Public equity real estate is to REITs, and public debt real estate is to mortgage backed securities or bonds of real estate companies. Then we have infrastructure. So there was a one question. So we have like it's a real estate investment or infrastructure. So real estate basically is like commercial property, residential property, but infrastructure is mostly like economic and social, schools, hospitals, and private partnership, like where public and private comes together to form like public infrastructure, like roads, ports, and bridges, like long term long term benefit of society also. Then we have natural resources, left developed land like agriculture, timber, mining. We also have commodities like precious metals, base metals, agriculture commodities, energy. Then we have other assets as are tangible, intangible. Tangible may we have art, wine, watches. Intangible may digital asset, that is also in our scope. Goodwill, litigation, IPR, patent. Now let's just uh, Now let's just discuss real estate investment only, what we discussed earlier, but in a much more organized way. So basically, in this matrix, we can just see like how many types, how many ways like real estate investment can be done. So real estate investment can be done like either in the equity, either in the debt, and even in both of them, we could do it like private privately, so that is direct. You can do it publicly, so that will be indirect. So private equity, we discussed like we are buying houses on our own. So if we look at it, private, that is direct, and equity, we buy property via partnership, or we are the sole owner, or commingled funds. Yeah. Then we have uh, indirect, like public equity, like how can we buy real estate through public equity. So for that, there is real estate investment trust. So these are basically like units you can buy in the buy in stock exchange. So these are tax exempt for REITs, tax exempt. They give back around 90 to 95% of profit as dividend, and they buy, hold, and rent the properties, like the trust. They buy, hold, and rent. They don't buy and sell, because uh, REITs are the investor for REITs are small investors, so that is why. So there is regulations on them, and their motive is not to trade property, because when the motive comes to trade and just to get like the maximized profits, so their the risk increases for the small investors. So that is why the main objective is to buy, hold, and rent to get a stable return. Their debt equity ratio should also be low. And then we have discussed this. Then we have how can we do private investment in real estate directly, but through debt. If we give a loan to someone who is going to buy a real estate from that money. And then public interest, that is mortgage backed securities, we discussed already. Now the second thing we are going to discuss is how to invest in alternate investments. So alternate investments, so there are a lot of charts in the core on this particular topic only. So in from this, like basically all those charts come together to one thing. So investing in alternate investment can be done through three ways. Direct investment, where we are directly putting our money, like example is Rakesh Jhunjhunwala. So he's like a accredited investor, so he will directly put his money, he knows where to put his money. So that is his direct investment in alternate funds. Or we can invest it through funds, so that is indirect, and that is like the most common and the most feasible way to do it. And sometimes what happens is there is one um alternate investment fund, so it has investors 1 2 3, and it further is invested in these companies. So what happens is it like here, like the assets under the assets of the committed capital limited partners is limited, and it's defined like it's a committed capital. So sometimes what happens is like the alternate investment fund get an opportunity to invest some more money in some of the other units. Then they just ask their own previous investors, like this is a fund, do you want to invest in it? And the fund, like, then the investors invest in it. So that is like co-investing, because this they are not going through the alternate investment fund is not investing in it. They are asking the one of the investors to invest in this C5. Now our next topic is the ownership structure and the compensation structure of alternate investment vehicles. So alternate investment, they have long horizon, large investment, illiquidity and complexity, and lack of transparency. And then for the structure wise, we know hedge fund and private equity, like both of them follow limited partnership, and they have a general partner that invests for them. Then we, for real estate, we saw like it's through REITs or joint ventures. Yeah, and there is a question also, so like joint ventures mostly for like what? So it's for real estate direct investment. I'll just write that also, real estate direct investment, because for infrastructure it's private public partnership. For real estate investment, the joint venture basically comes from like a real estate investment has a lot of like external factors that affect them, like politics and geography and community. So for that, they like investors like get into a joint venture with like local parties and local investors or local interested people, just to get like that expertise, and together they can invest and like have a much more informed decision for the investment. Then we have the compensation structure: management fee plus incentive fee. Incentive fee is called as carried interest, performance fee, and one more name we read through earlier, that is um, carried interest, clawback provision. I don't remember. Yeah, preferred return and preferred return. I'll just write it here. Preferred return. Then management fees we talked about, like if it's from a hedge fund, then it will percentage of assets under management. If it's private equity, then it's percentage of committed capital, all the capital, so that general partner does not just go and invest all the capital. He can like selectively and slowly make a wise decision. Incentive fee we talked about, it could be independent of management fee or not independent. So and then it also have hurdle, soft hurdle, hard hurdle. Then in and after hurdle there is also high water mark, and there is a clawback provision. And then there is this concept of catch up clause. So catch up clause, if you have any question, just think about soft hurdle and solve it basis soft hurdle, and you will get the correct answer. Then we have like distribution waterfall. There are two models: American model or European model. That is deal by deal, like limited partner and general partner fees will be basis deal by deal. Each deal they'll close and they'll give fees. But European model is like whole of the funds, like limited partners will be given like their capital plus their preferred return firstly, then only the general partner will get its fees, and then after that it will be an 80-20 percentage, whatever is defined. So this was basically our learning module 1, and after that we have our learning module 2.